Hello sector watchers, welcome to the show. This is the 139th episode of Sector Spotlight for Tuesday the 9th of August. I'm recording it on Monday the 8th. My name is Julius de Kempenaer and I am presenting to you from Amsterdam in the Netherlands. My contact details are on the screen. We have no time to lose because I already recorded most of the content and I'm going to run into trouble at the end. So I'm going to quickly give you the agenda. We're going to start with growth value rotation. We're going to take an extensive look at various sector rotations and then bring it all together in the chart of the S&P 500 and what we can expect next. No time to waste. Let's get started. This is Sector Spotlight. Before we move to the individual sectors, I would like to bring up the growth value rotation on the relative rotation graph. And we have the weekly growth value rotation on the left and the daily on the right. And to be honest, that message is pretty clear. If you look on the weekly, you see growth traveling through improving and almost hitting leading, and value obviously is on the opposite side. It's traveling through weakening and almost hitting the lagging quadrant, suggesting a clear preference for growth stocks at the moment. And that's what we see in the markets. See a lot of growth stocks picking up. If we go to the right hand side of the screen where we see the daily version of this chart, it's actually underscoring again the preference for growth over value. You see growth clearly inside the leading quadrant while value is clearly inside the lagging quadrant, and they are moving in opposite directions. And if we scroll back through time a little bit, then you can see how this has been playing out. So we're now here in May, and here you see, now we're going for the last, so here is the last moment. So June, mid-June, growth crossed over into leading, value crossed over into lagging, and since then growth remained on the right-hand side, value remained on the left-hand side. We had a little dip for growth from leading to weakening and for value from lagging to improving. But that has recently changed again. It has picked up in favor of growth, quite rapid change back to favoring growth over value. I'm doing it again. And this is where we are right now. And this is clearly supporting more strength for growth stocks in coming days and weeks, I'd say. Another graph that when I look at growth value, I also like to look at size, the size definition. So if you look at size, so growth, large, mid, and small caps. And if I bring up those RRGs, and I do the daily here, then we see a bit of a different picture. Because here right now, large caps are favored. They are crossing into the leading quadrant, and small caps and mid caps are ending their positive streak. They moved from leading through weakening, and now mid cap's already inside lagging, and small cap is almost inside lagging. And that image is supported by the daily graph, where large is picking up again and mid and small caps are losing relative momentum, and mid cap will soon cross over into weakening where small caps already are. And those two images, so growth value and size rotations, are, I think it's conflicting, because growth obviously is bullish for the market. That's supportive for a strong stock market. But usually a strong stock market, a new rally or a strong stock market is driven by a move to small caps. They are usually the first to pick up. And large caps are more like a move to defense. And that's what's troubling me right now. We've got this clear move to growth stocks, but we're also moving to large cap stocks, and we're going out of small cap and mid cap, and that doesn't really that doesn't really match that image. And that's something that I have in the back of my mind, that I still need to be very careful with being all out bullish for the market as a whole. There's definitely good pockets to be found, but I'm not sure whether this is the end of the decline as we've seen it, or is there a little bit more in store for us. And so I'm not super bearish. I think we're going through a good phase, through a recovery, but I need more evidence that we have seen the low and that we're ready to make the jump into a new move higher. And in order to do that, I want to talk you through the various sectors. And for this show, for this episode of Sector Spotlight, I decided to start with this growth value rotation and then pick up sectors and then see how much time there is left to talk about asset classes and maybe something else. Because otherwise the story about sectors gets a little bit squeezed in at the end and doesn't get the attention that it deserves. So let's have a look at some of the individual sector rotations. Here we have the RRGs for sectors. On the left-hand side we have the weekly, and on the right-hand side we have the daily RRG. That's the high-level overview. Let's start there. From the weekly image, I think it looks pretty much, the direction of the tails looks pretty much as it's been over the last few weeks. We see discretionary and technology insight improving and traveling at a strong heading towards leading. Communication services rolled over, is now stalling. We have financials clearly inside the lagging quadrant and moving further into it. Real estate is shaving the 100 level on the RS ratio scale and moving higher on the momentum scale. We've got materials clearly moving into lagging, that's a negative. And then we have industrials, and let me highlight that because you can almost not see it. It is now it's stabilizing. It's inside weakening, but it's very close to the center of the chart. And then we have healthcare moving at a negative heading into the weakening quadrant. Staples are inside weakening, they're leveling off. Utilities are inside weakening and moving lower on both scales. And so is energy, that's still making that very long rotation on the outside of the RRG. And let me let me tick off this tail so we get a better handle on the others. And you see how that image is in balance, with one interesting observation: there's no sector inside the leading quadrant at the moment. And that is because the big ones, discretionary and technology, are inside improving. They need a lot of counterweight on the opposite side. And that is coming from those three. And that means that there are currently no sectors inside the leading quadrant to balance out the graph. Nevertheless, the strength is currently in growth, as we saw, especially with discretionary. And technology is inside the sensitive group, and that's going up. I quickly want to move to the daily and make the comparison, and then we go break down the sector into the three groups: offense, defense, and sensitive. If we look at the recent rotations, then we have discretionary inside leading, but it's rolling over. That is supporting the strength of the discretionary tail on the weekly RRG. But the question is that strong enough to pull it all the way into the leading quadrant? Time will tell us. Here is technology, that is doing quite all right, and that looks like we're gonna see technology moving into the leading quadrant on the weekly this week or next. If we look at industrials, they are inside leading but rolling over. That matches the image on the weekly, where industrials are very close to the center of the chart, so more or less in line with the benchmark. Not much to gain, not much to lose there in that sector. And then we have materials. Materials is rolling over inside the improving quadrant and already heading back towards lagging. And that doesn't bode well for the weekly RRG, for the weekly tail, because that's a long tail. That's one of the longest tails on the weekly RRG, pushing materials deep into the lagging quadrant, and that's going to be supported by the weak rotation on the daily RRG. So materials is on the watch list from a negative point of view. Then we have utilities, and utilities are doing the opposite. They're inside improving and they're picking up again. So with utilities being the highest reading on the RS ratio scale, there is plenty of room for this tail on the weekly to curl back up and start moving towards leading without ever hitting the lagging quadrant. And the strong tail on the daily RRG is a sign that we could be seeing such a rotation in the next week, maybe 2 weeks. Energy is interesting to see. It's rolling over inside the improving quadrant. And starting to head lower again, while if you remember that long tail of energy on the weekly RRG is still inside weakening and moving lower. So it looks like as if we're going to see a little bit more relative weakness for the energy sector in coming weeks. Real estate here is very close to the benchmark. There is not much to gain, not much to lose, and it matches the tail of energy, real estate on this weekly RRG. And then we have communication services. As I said, it's rolling over. Here it's deep inside the lagging quadrant, picking up a little bit, but that's not merely enough to do anything for that tail. So communication services remains a weak sector from a relative point of view. And then we have healthcare. That's pushing further into the lagging quadrant, while we have the tail on the weekly pushing into the weakening quadrant, and that is opposite rotations. It's one of the defensive sectors. Utilities were actually starting to pick up again. That's not happening for healthcare. So here healthcare, the daily is looking a lot weaker than the weekly, and the question is who's going to win that battle. Staples, quite similar. You see that the tail is bending back to the left again on the daily RRG, pushing further into the lagging quadrant. And that's coinciding with what's happening on the weekly tail. It's leveling off here, but with that tail moving lower on the RS ratio scale, it's going to be very hard for that weekly tail to pick up relative strength. So 2 out of 3 defensive sectors looks as if they need to go through more weakness in coming weeks. And then another one that is very clear, together with materials and with technology, is the financial sector. Financials, the daily tail has just moved back into the lagging quadrant after a short move through improving, and it's now back in sync with the weakness that we see for the financial sector on the weekly RRG. Now let me go and show you the breakdown into offensive, defensive, and sensitive, because I think that's an interesting breakdown, and it gives us an interesting picture. So here is offense, and in one shot I can immediately see, and we already saw all these tails, but now you're going to see them grouped. So here's offense, and what this picture really tells me is that the only thing in offense that's really good is consumer discretionary. That's XLY. The other 3, well, at least 2, financials and materials, are pushing further into lagging, so that's not good. Real estate is in the middle. It's not going anywhere. It's picking up a little bit of momentum, but there's no relative strength there. So the only strength for the offensive sector is coming from consumer discretionary, and because that's such a big sector in terms of market cap, that's obviously going to drive growth stocks higher. So that's the image for the offensive sectors. There's really only one that's doing really well, and the question is how long it will be able to maintain that rotation. Here is the defensive groups, and these are utilities, healthcare, and staples. And we already saw that utilities are actually bending back up. So they're kind of giving utilities on the weekly the opportunity to roll back up. It's not happening for staples and healthcare yet. However, these two sectors are still quite some distance away from the 100 level, so there is still some room to maneuver. And don't forget that they are inside weakening, but they're also on the right-hand side of the graph. And on the right-hand side of the graph means that they're still in relative uptrends versus the S&P 500. The uptrend's losing strength, but it's still there. So there is still strength in defense, and we saw that the strength in offense is merely coming from one sector. And then we have the group of sensitive sectors. That's energy, industrials, tech, and communication services. And here it's interesting, and that caught my eye, is looking the same as the group of offense. There's really only one sector that is doing really well here, and that's technology. The technology till is almost inside leading. If you look at industrials, it's moving at a negative heading. Communication services has just rolled over and is moving towards lagging. And the energy till is the longest one. It's got the most power behind it, is almost crossing over into the lagging quadrant. And putting that all together makes me still cautious with regard to the market as a whole. This type of sector rotation, as we are seeing it right now, is definitely supportive for discretionary and technology. The fact that those two sectors are currently showing strength is creating a good rotation for growth versus value. But we also have the fact that large caps are picking up versus small and mid caps, which is usually a little bit more defensive. And we still have all the defensive sectors on the right-hand side of the graph. So there's my, call it a dilemma if you want. I do see growth picking up. I do see the strong rotation for growth stocks. If I look at the individual sectors, I have to conclude that it's actually only coming from two sectors, from discretionary and from technology. And I also have to conclude that the defensive sectors are still on the right-hand side of the graph. So that's a bunch of mixed signals. Well, let's walk through the individual sectors and see what we can find on those individual graphs. So here's materials. As I said, pushing rapidly into the lagging quadrant, and we see that here. That relative strength is rapidly losing strength, and we are making a pullback, but we are running into resistance at the old support levels. So the upside for materials will be quite difficult in the near future, I think. Here is communication services. We did see a bounce, it's inside the falling channel, and relative strength has just deteriorated further. So it's not strange if we see more relative weakness, and that is almost, well, there's no guarantees here, but it looks as if we just rallied within the falling channel and we're preparing for a new move lower inside that falling channel. Look at energy. We bounced off that support. So here the relative strength was still good. It is still good, but it's rapidly losing momentum. And we do need to hold above this like 65 level, but combining the price chart and the rolling over in terms of relative strength makes me think that we may need to see another leg down before we can move higher. And that will almost certain make that relative strength go a little bit more negative than it's already been. Here is financials. That's one of the sectors that's showing a very clear picture. We're seeing that rally. It looks as if we're like 3 weeks ago, we had that high. Last week didn't do much, and today we just pushed higher and closed quite lower. That series of lower highs and lower lows is fully intact. There's no doubt about it. If I extend that trend line, I need to do that on my annotations, that's still pointing lower. And you can see that relative strength is about, well, it is not about to, it is breaking support here, pushing the RRG lines lower. So that is pushing the weekly and the daily tail further into the lagging quadrant. That's not good for the financial sector. And here we have industrials, very close to the benchmark. And as you can see, relative strength inside that range. We're hitting the upper boundary. Maybe we come down a little bit. And if you look at price, we are here hitting resistance coming from old support. And that's a theme that you see in a lot of charts, that the rally that we are currently seeing is hitting on resistance that is formed by old support levels. Here is technology. This is technology and discretionary. Here's technology. That's one of the sectors that's doing quite good. It took out its previous high, it took out its previous resistance level, came out of the falling trend channel, so that is good. It's picking up in terms of relative strength, so that is good as well. But will the technology sector, together with discretionary, be strong enough to actually drag the entire market around? That's my big question. I'm not really sure about that. So here is staples. Sideways in terms of relative strength. We've got the tail leveling off here. That's what you see on the RRG lines. And here also is a market, is a sector that's rallying, and it's finding resistance at an old support level. In this case, it's an old rising support line that is now starting to act as resistance. So here, another sector that will have difficulty going higher. The upside is capped by old old support levels that are now coming back as resistance. Here is real estate, another example. We've got that almost perfect head and shoulders level. It reached its minimum target barely, just hit it, but it fulfilled its target. It's now pulling back, and we're now finding resistance at the level of the neckline that marked the bottom of that head and shoulders pattern. So here's another sector that's now hitting an important resistance area. Here's utilities. Not as clear as the others. You can see here the weakness in terms of relative strength. That's because of the move to growth, to discretionary and tech over the last few weeks. But that relative strength line is actually holding up quite well, and you can see that the RS ratio is still at 104.5. That's still quite a high level. So the move here in terms of price is hitting at the resistance level of the previous high. That is running another resistance level, but it's not as bad as the others. So utilities, I think, have, especially when we can push higher here, have the ability to rise further and for relative strength to actually pick up again. If we then move to healthcare, as you can see, a rally that's running into an old support level that's hitting now as resistance. It's starting to act as resistance. Relative strength still okay, but rolling over. It's losing relative momentum. There is some weakness there, but you can see the high reading of the RS ratio value is still holding up the relative trend here after the break out of that big base in the raw relative strength line. In terms of price, we're hitting at resistance, but it's not a real downtrend, so it's more like sideways. And then finally here we have the consumer discretionary, as I said, one of the two sectors that is really, really strong. When you look at price, we did complete this double bottom, but we are now hitting on that falling resistance line. And this is only 1 day trading, but we respected that overhead resistance around 170. We'll have to see how that works out for the rest of the week. Relative strength is still showing lower highs and lower lows. So all in all, I see basically only two sectors that are doing really well, discretionary and technology. I see financials and materials doing really bad. They are pushing into the lagging quadrant. I see strength for growth and weakness for value. That's not strange. That's coming from discretionary and from technology. But I also see strength for large cap and weakness for mid and small caps. That's not corresponding with strength for an overall market. And I see defensive sectors still on the right-hand side of the graph. Despite the loss of relative momentum, they are still strong. So where does that leave me for the S&P as a whole? Let's have a look at the asset class charts and we'll bring in the S&P right there. Okay, so it's a good thing that I actually started with sectors, because now I have only a few minutes left to talk about the asset allocation. Basically only about the stock market, about how it all wraps up into SPY. I just told you the story about what I see in the various sectors. If you look at the RRG, you can see that SPY on the weekly tail is moving higher, still on the left-hand side, and you see the rotation of fixed income going the other way, and commodities are still distorting. They're still moving their way through weakening, heading further towards lagging. The shorter term picture shows SPY on the right hand side, but still not at super high levels, not at super strong headings, but at a very short tail. So it's still very close to the benchmark. If I look at the individual charts of the S&P 500, so here's SPY running into resistance. So here is the resistance that I'm watching. It's around 417, 415, 417. That's the area where I think resistance will come into play. And you see that magnified when you look at the daily. It's the same area, and you see that we touched it last week. Today, on Monday, the opening was above it. We peaked a little bit and then we closed lower. And you can see a slight negative divergence building up in this RSI here. And this is kind of corresponding with a lot of sectors hitting old support levels that are now starting to function as resistance. And that divergence, I know it's a little bit dangerous because this show is going to be aired 24 hours from now. But if you look at the hourly chart, then you can see that there is quite a big divergence building up on the hourly chart between SPY and the RSI. And that suggests that we're going to see at least a pause here around 417. That all fits in with the narrative of the sectors hitting resistance. And I think it's just, if we go higher, at least we need a little bit more time before we really go higher. For the time being, a lot of resistance level overhead are waiting for us. That's it, we're done. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Looking forward to see you again next week, same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.